Okay, we'll get started. Good morning. My name is John Von Paris, and I'm the chairman of the MDTA Finance Administration Committee. And I will be conducting today's meeting. Today is Thursday, August 13th, 2026, and I hereby call the meeting of the Finance and Administration Committee to order at 9 a.m. In accordance with the live streaming law, this meeting is being conducted via video conference and is being live streamed on the MDTA Finance and Administration Committee webpage. As a reminder, all members of the committee will have their video active during the entirety of the meeting. To minimize background noise during the call, I would ask that everyone on the line please mute phones. Anyone who is presenting or answering a question, please turn your video and audio on when speaking. When you're done, please turn your video off and put your audio back on mute. There are no members of the public, no elected officials, and no media that have pre-registered to comment at today's meeting. At this time, we will move on to agenda item number 1, the approval of the July 16, 2026 open meeting minutes. Is there a motion to approve?
So moved, Member Rosen.
Thank you, Member Rosen. Is there a second?
Member Ardinger, I will second.
Thank you, Member Ardinger. All those in favor?
Aye.
Opposed? Motion carries. The minutes are approved. We'll move on to the next item on the agenda, number 2, approval of the investment committee report. We have Clayton, Kevin, and Ellen presenting this morning. Good morning. Hi, Clayton. How are you?
Hey, good morning. How are you?
I'm fine, thank you.
Great. Well, we appreciate your time this morning, and as usual, or per usual, on our quarterly basis, we like to come before you and present the update, the status of the financial assets investment portfolios for the agency. Portfolios remain diversified, although we'll qualify that a little bit later. I think the important point there is they remain liquid. We'll see why I refer to it that way in a few minutes, but importantly also they remain in compliance with the investment policy and the trust agreements. As we've mentioned several times now, higher prevailing rates are helping the returns. Consistent with that, typically in the economy, we're also seeing higher inflation.
I think you're coming. I can't hear you. Can everyone hear? Clayton? We cannot hear you.
Bluetooth challenges. Been there.
There we go. Yeah.
We'll give him a moment, and then either Kevin or I could take over a presentation to keep things moving. I'll give him 30 seconds.
Okay. I'm gonna check.
Thank you. Is that better?
Yes.
Many apologize.
Oh, no problem at all. We can hear you.
Maybe I should start over. Would that help?
Sure. And can everyone else hear Clayton?
Yes.
Pretty much. Okay. Thank you. Thank you, Clayton.
Okay. Again, apologies. So the portfolios, the financial assets of the agency, the investments remain very diversified, although we'll qualify that in a few minutes here later on in the slides. The important point is they remain highly liquid, and that's of chief concern to us on an ongoing basis. They're also in compliance with the policy and the trust agreement per statute, and so that's an important point or takeaway for you as well today. As I mentioned, the match funded accounts are benefiting from higher rates, higher yields. That's good, but it also means typically there's an association with inflation prints, such as consumer prices and producer prices. And we saw that yesterday and again this morning as those remain elevated and sticky and somewhat disappointing, but we'll take the yields for sure. The long-term reserve accounts, total return accounts are consistent with their mandates. Again, the general account can go out to 5 years and the M&O can go out to 15 years. We've seen compelling returns there on an absolute and relative basis, and so that's exciting. Moving on to slide 3, I mentioned higher than expected sticky inflation prints, which means federal funds target rates are high. There's been a little bit of dissent as to whether or not the Fed should lift rates, but for now they're holding steady, and we'll see what happens for the rest of the calendar year. You can see on the graph there that that core PCE does remain sticky and higher than has been witnessed for about 30 years now, at least. So a bit disappointing the Fed hasn't been a little bit more on their mandate. Moving on to slide 4, we see the Treasury yields as well as some of the prints for real GDP and unemployment. Unemployment remains healthy, or I should say, employment remains healthy while unemployment is fairly stable and in line with the expectations. Moving on to slide 5, I mentioned, referred to the fact earlier that we're diversified, of course, but we're also very highly liquid. You'll notice that these numbers have changed materially since the last quarter, and noticeably in the Treasury and agency sectors of the market, as we received the settlement proceeds, just over $2 billion from the Keybridge litigation. We decided to take a laddered approach to investing those assets, and so some of the monies went to work in the local government investment products. A lot more went out to discount notes in the agency space, and then a material amount of those assets were invested in treasuries out to about 3 years. And we can see this on the next slide, slide 6. The blue portion of those bars represents primarily the proceeds from the settlement. And again, we're very liquid at the front end of the curve, 0 to 1, 1 to 2, and then a little bit less so in the 2 to 3. And that corresponds with projected spending for Keybridge rebuild, as well as some other capital projects. Total return accounts are consistently at plus or minus 400 million, typically just over 400 million, and so that's important to note as well. Moving on to slide 7, we go through just zooming in on the general M&O accounts, the maturity distribution for those two. And no, nothing has changed materially. This is a pretty consistent chart and table that we show you every quarter. On to compliance on slide 8, all of the portfolios and mandates are in compliance with the policy again and the trust agreement. As we mentioned earlier, we specify the maturity for each of those types of strategies, as well as the policy limit, and you can see we're within compliance. Moving on to slide 9, again, we'll see the Treasury allocation is fairly large at $1.3 billion. MLGIP is quite substantial at $500 million. And then we've got a fairly good piece of invested assets in the agency, specifically the Federal Home Loan Bank, that's where we've seen the best opportunities to get those monies invested. Moving on to slide 10, we see the exposure to the municipal markets, where we invest on an opportunistic basis, exclusively in the general and M&O accounts. And these investments have come down a little bit as we've had a couple of maturities, as well as have received some sinking fund payments of recent. And so we do expect this to be, roughly around 150 million as opportunities exist, and as they don't, we'll see that come down a little bit. We'll talk a little bit more about that exposure later in the presentation, and then again during the policy overview update. On slide 11, this is important to see that we've expanded our purchases, primarily purchases through the dealer program or the established dealers that we have in the program. As we put these settlement monies to work, we notified all of the dealers that we would be in the market, active in a big way, and gave them the opportunity to participate. There were opportunities to give a little bit to every dealer for the most part in the program. A couple had opted not to participate, but for the most part, we got everyone involved, and that's good to see. And then you can see there that the most competitive, the correlation between the trades and the most competitive is fairly high at one almost, where FHN and Huntington and Piper Jaffray showed up and were very helpful for us. And I'm referring to the green bars there. Following on 12, the strategy. We manage the portfolios to a target of plus or minus 3% to the index on a duration basis. As you can see, we're well within that mandate, and there have been no issues with respect to that, and are pleased to report that we can match that. We don't take interest rate risk. We don't take yield curve risk. And so we're just taking a little bit of duration once in a while, and we're underweight a little bit once in a while. And it's fairly steady on average at 100% of the indices, or respective indices. Moving on to slide 13, I'll turn it over to Alan to discuss the forthcoming debt service reserve fund that we'll be setting up.
Great, thank you. Yeah, we thought it would be helpful to provide a little background. We'll have two new accounts, their debt service reserves associated with this financing that's upcoming next week. We're issuing or generating about 360 million of bond proceeds of toll revenue-backed bonds. So that sale occurs next week. With each of our financing, typically fund what's termed a debt service reserve. And so the rating agencies have an expectation that there's an additional liquidity reserve to support your bonds in the event of a revenue shortfall. So those reserves are typically funded at the lesser of 3 tests. The IRS has a limitation on that. It's typically equal to your maximum annual debt service. So for the toll revenue-backed financing, that's about 26 million. All of our other existing debt service reserves are currently funded with insurance policies, termed sureties. And one of the analyses that we do each time we have is to consider the present value cost of a surety versus the carrying cost of a cash funded reserve. And in this case, it's much more beneficial or economic to fund with cash. And I'll explain why as we proceed through this. So our recommendation is to essentially buy a 10-year security for these reserves that are likely to be around, for the life of the debt, which is about 30 years. One other bit of background is that when we closed our TIFIA loan a few years ago, we had a covenant once we issued debt again for another group of bondholders. The Build America Bureau, or the US DOT, wanted to have the same level of security for their outstanding loan. And so we made that commitment. So we'll also have to, back fund a TIFIA loan reserve. That's an additional 12 million. So we're essentially setting up two debt service reserves with this financing. The financing closes on September 1st, and we thought it would be helpful to come to the Finance Committee with a recommendation in advance of funding that with a longer-term investment strategy. So on pages 12 and 13, there's some highlights about the rationale for the decision. So when you look at a surety policy, you pay an insurance premium up front, so you don't pay it all up front, and the life of that surety is typically only 10 years, and that's because when you refinance your debt at the 10-year call date, the surety doesn't move forward with the refunding bonds. So when we analyze the present value of the cost of the surety versus the carrying cost of the cash, we're looking at that 10-year time frame. And when we looked at financing rates, around 4% and the ability to buy a 10-year treasury or agency at more than 4.5%, we'd have no net carrying cost for that cash. Essentially, we could borrow it less than the investment rate. And so I think that helps to underlie our investment recommendation. So you can see on page 13, we have some investment goals, and that's the first goal is to really minimize your carrying cost or the differential between what we're borrowing at to fund the reserve and then the earnings rate. And then our second goal is to minimize the return volatility. In the event of a sharp interest rate rise, we would have mark-to-market losses in those debt service reserves. The reserves have to be tested at market value and per the trust agreement. So if there's a shortfall or the value of that reserve falls, we would need to take excess operating revenues and add it to the reserve. So we have those two goals, and we're trying to balance, a longer-term portfolio to generate a high enough return to effectively wipe out any carrying costs. We can earn more than we're financing at, but at the same time, we may not want to buy a 20 or 30-year investment because it would expose the portfolio unnecessarily to more rate risk. Additionally to those investment goals initially is that annually you're looking at purely your forward-looking return, not necessarily what's happened in the past. And we have the opportunity to do additional break-even analysis and present value analysis each year if interest rates change. So we'd be reevaluating surety premium costs versus the present value of the carrying cost. I think on page 14, some of this may be a little easier to digest in this table at the top. What we were modeling a week or so ago was the cost of this financing to maturity of about 4.38%. The probable cost for the agency is the cost to the call date. We're planning to issue premium coupon bonds, so you're more likely to be able to refinance those at the 10-year call. So the cost of the call is about 4.04%. At that time, 10-year treasury rates were about 4.6%. So you can see that either to maturity or to the call date, that those reserve investments, if we lock in a 10-year investment, we can earn more than the cost of the financing. The reason why I put the duration measure in there is that duration is a measure of return volatility, and it's essentially modeling a 100 basis point instantaneous move in the yield curve and what that would do to your investment. So for a 100 basis point move up in rates, that would be 7.9% downward mark-to-market move in that investment holding. However, interest rates are relatively high now, so your accruals over a 12-month period would offset a lot of that mark-to-market decline. So I put this requirement just as an exercise to show the relation between annual income and the volatility. These two combined reserves are closer to 38 million, but on a $20 million reserve, the annual income of that 4.6% is throwing off approximately, $920,000 a year, $1 million a year in income. That income must be pulled out of the reserves per the IRS rules, so that would be available for capital projects. And you can see that, in 1 year's time period, we could gain essentially or have income that would exceed, the cost of the surety premium. So, it's very advantageous in this environment to, fund with cash or bond proceeds rather than buy an insurance policy. The last line there says potential deficiency, 100 basis point yield curve shift. So that's showing you both the mark-to-market loss instantaneously and also the effect of accruals offsetting some of that decline. So potentially in a 1 year time period with a big shift up in rates, you could have a mark-to-market loss in the portfolio and you would need to replenish that reserve. But it's also important to understand that as interest rates rise, the accruals would also rise so quickly the following year you'd be pulling back out, more than $1 million of income, and so you would essentially reach the operating income that you use to bolster that reserve. So over time, what we're thinking is that we're doing a couple of things. Some of it is asset liability matching, and some of it is immunizing the portfolio against interest rate risk. So by locking in this long-term 10-year treasury return or agency return, you're locking in this return that's above your cost of financing and relatively matching it to that 10-year call date, while the reserve will continue to live after and be needed after the call date. We will have the opportunity in those 10 years to reevaluate, cash funding versus surety policies. So we think that while you could go in and buy a 20-year investment or a 30-year investment, we've achieved, or we can achieve, positive arbitrage effectively by purchasing a 10-year investment at a yield above our cost of financing, and then not expose ourselves to any more volatility and returns than is necessary to achieve that first goal. The TIFIA loan is a little bit different structure than this municipal financing in that it's continuously callable, and we had achieved a low financing rate of less than 3%. So while that isn't economic to currently refinance, as some of the longer or higher coupons of the tranches disappear, we will have refinancing opportunities, and there's some expectation that refinancing may occur before 10 years. We have that flexibility. So I think annually there's a couple of key points is that annually we have to test for sufficiency of that reserve. The IRS limitation on funding is at the time of issuance. The trust agreement directs us to look at it annually and test for adequacy. And so we want to pull out the excess income each year, but also potentially we could have to add funds to the reserve there. That's a lot less likely in this high rate environment. And then also annually we'll be performing break even and present value analysis versus a surety in different rate environments. And so we're very much forward looking about what the probable investment returns are versus premiums. And so before we move on toward the last couple of slides in the conclusion, I just want to make clear that the recommendation to the Finance Committee is to get your concurrence so that we can move forward to the full board for approval. And so a recommendation of the Investment Committee is to purchase a 10-year investment for these two reserves and to essentially hold it and reevaluate that strategy annually. And then Clayton had showed the previous slide where we will typically show this strategy. So once that strategy is approved, we'll amend that prior table for the next quarterly meeting. So we'll be tracking the investment returns against our benchmark, which is essentially we're trying to out-earn our cost of financing, and we'll have some narrative on that side about the rationale for that, and that will remain, more or less indefinitely until we remove those. One other point in closing is that some years ago we had several cash-funded debt service reserves, and we came into a very low rate environment, and we made the recommendation to the board to pull those funds out of the debt service reserves, replace them with surety policies, and we utilized that cash toward the capital program. So that's why you haven't heard about debt service reserves in a few years, because we haven't had any cash funded reserves. So I'll pause there and give everyone an opportunity to ask any questions.
Okay. Are there any questions?
I have a question. So Alan, so I understand the balancing act, and I think that makes a lot of sense. If we're higher at the onset and there's an excess earnings, and then you get to a year and then the mark to market now it's below, does it account for what happened in the past, or is it just where it is at that point in time and now it would require us to fund out of operating in the future, even though you hit the game previously?
Right. Yeah, that's an interesting nuance, is that the IRS adopted these, rules against, earning arbitrage and abusive practices over many years. And so essentially the IRS overfund the debt service reserve. So they have this lesser of three tests at the time of issuance. Your reserve has to be funded at your maximum 10% of bond pros and 25% of average annual debt service. So if we initially funded 26 million, that's equal to MADS. That's the lowest of the three tests. And so for a year when we'll generate about $1 million of income. If we don't remove that income from the reserve, IRS earn arbitrage on. So we very need to get that money out of the reserve. So each year we'll be pulling that out. And so I think try to keep the reserve constantly funded at MAD, because we'll be pulling the excess. So going to sit anywhere else, it will end up in the capital account and be used in the capital program. So if 2 or 3 years from now, interest rates were to rise dramatically and we have a mark-to-market loss at the end of the year in the portfolio, and it's below that $26 million requirement, we would add funds. I think the answer to your question is we would have consumed and removed that excess income, and we would have already spent the account, so have to replenish it. So we can't, to answer your question, accumulate and let the reserve keep growing, because we would then expose ourselves to additional calculation requirements for the IRS. And there's a concept called arbitrage rebate, and so we have to make those to the IRS every 5 years. We have to test, and we would potentially have to rebate that excess earnings on the excess that was in the reserve. So we want to avoid that. So we'll be now with the and removing the excess.
Are there any other questions? Member
I have a
Carroll?
question.
Member Carroll.
Two-parter for you, Alan. Are there any specific risks that the investment committee is concerned about that could be on the horizon for the next year or two? And with those risks, if there are there any specific triggers that you guys are contemplating that might have you thinking about changing strategy?
Yeah, we're concerned about volatility. Our focus is always on long-term returns. So I think we always accept some return volatility and we try to balance that with the ability to use operating revenues to replenish a reserve. And so I think it's the same strategy with the general account and the M&O reserve. They're long-term in a broad, in perspective with the agency's revenue, and then recognizing that quickly the accruals the following year are likely to just replenish that. And our look toward that for 10 years we've been, those mark-to-market gains and losses don't really matter to us because we're not necessarily planning on selling that investment before maturity. We've locked return the security again before. And so I think the answer to your question is we can manage that volatility in those two reserves as well as the general account. You know, in the general account, if we have mark-to-market loss there, so replenish it from operating revenues, but then accruals came into the account, we would, you know, very quickly over a few months probably pull that money back out. And that's been the pattern for the last more than 10 years. Money to the account in some years sharply rising, and then the money's come as we had accruals in those.
Thank you, Member Carroll and Member Rosen also. Okay. Screens. We'll see if is your question complete on this, Alan, and specific.
On that particular subject, I think I just wanted to pause and let Clayton finish. And there are Clayton.
The as one reserves value an opportunity to the general, and so when in supranational, municipal, and commercial paper, we're always evaluating purchases. Again, some threshold and the conditions recently, it's been difficult to find out. But these CP is trading super, at least relative to are quite rich and many parts of slot being there. Past hope that you'll focus on this 3-year period. We definitely appreciate the performance, but hope is that you'll focus in on the 36-month period. Annualized returns, as you may have seen, 5% to purchases were referred in that. I'll open up for any questions.
Any questions?
And this is with the quarterly performance report presentation. The request Finance and Administration Committee's concurrence and recommendation to move to for approval of the 2026, if I may, investment policy changes.
Okay, thank you. Okay, is there, well, thank you for the presentation. Is there a motion to advance this item for approval?
Member Artinger, I will so move.
Member Portinger, is there a second?
Second, member.
Thank you, Member Carroll. Is there any further discussion? All those in favor?
Aye.
Aye.
Opposed? Motion carries. Thank you again, all of you, and for the prison.
Thank you.
Okay, we will move on to the next. Bear with me a second.
If I may, while you're.
Yes.
So that typo, maybe I should mention it, is bottom. And it's not highlighted on your page 4 of the policy, which is the 35th page of the document, and it's 4.2. It says to the so insured, and we just need to fix that to say to the extent.
Okay.
So that would be our other range.
Okay.
Thank you.
Is it possible to just send that to the members with the revision?
Certainly.
Thank you.
Certainly.
That way they have it for their file. All right.
Thank you.
We've now reached the closed session portion. The closed session for the Finance and Administration Committee members and designated staff. For those persons who are in this meeting or on, we have completed the closed session, we will come back to the meeting to ratify any actions that might be taken in closed session to continue with the remainder of the agenda. We appreciate your patience. Per the Maryland Open Meetings Act, the MDTA will meet in closed session under the general provisions, Article Section 3/305. Contract is awarded or bids are disclosed directly related to it or the content proposal. If public discussion or disclosure would adversely impact bidding or proposal. So at this time, is there a motion to go into closed? Is there a second? Thank
Member
you. Okay. And just as a comment, when you do, when we vote for this, if you could recording of this, because we have to document that, you could, when you just say yay, nay, or abstain, if you could. So if we could start with that, member Carol. Rickson.
Yeah.
Okay, so that's document, and we will, it's 9:46, and we'll go into session. Thank you. Okay. We are back in open session. We've concluded session number 2 of closed session number 2. And there was a recommendation made and approved to seek recommended approval from the Finance and Administration Committee to present a reimbursement agreement for lost revenue protection. Contract MA28680000 electric toll collection 3G to the Full Maryland Transportation Authority Board at the next scheduled meeting. Megan, is there anything else that needs to be, are you satisfied with?
All good here. Thank you.
Okay, so we've already made the motion in closed session, is that correct?
Correct. Yes.
So we're just making a statement here, right?
That it was ratified. Correct. Yes.
Okay, very good. Okay.
Yes. Thank you. Thank you.
Thank you. Thank you. Sorry for the confusion here today. So that concludes everything on the agenda. And so it's time to adjourn. Is there a motion to adjourn?
Same with Member Rosen.
Thank you, Member Rosen. A second.
Second, Member Carroll.
Thank you, Member Carroll. All those in favor?
Aye.
We stand adjourned. Thank you.